Hello, hello, hello. What's going on, everybody? Welcome to Al Stock Trades. How's everybody doing today? All right. So check 1, 1, 1, 2. All right, we got the mic inbound. All right, guys. What's going on, Ken? How you doing, Kenneth? Ken and Kenneth in the house. What's going on? I appreciate you, brother. Appreciate you. Appreciate you. Read all the comments right now. Appreciate you here. All right. So what's going on, Mr. Johnny? All right. So this video is going to be a pretty good video here. We're going to go ahead and calculate the intrinsic value given a couple of data that we've gotten, especially from the CEO of Oscar. We're going to talk about a little bit of academic stuff. We're going to talk about the earnings this week. We're going to talk about the Donald Trump signing a deal with EU and also Japan. Talk about what's happening overnight and also a little bit of speculative market with open. Look at Oscar, look at Clover. Go ahead and look at this and figure out kind of what I'm talking about here. Then related to what the CEO of Oscar was saying, look at the price to earnings of Oscar, right? And then go ahead, talk about PLTR, and then do a couple of short stuff here. But honestly, go ahead and calculate the intrinsic value. Look at the intrinsic value. Look at all these different types of things, okay? So definitely a lot to talk about, a lot to squish. Very quickly from the technical analysis standpoint, you can see right now we're in this ascending ascending channel, right? A lot of people, you go ahead and remove this and remove this. People really can't see it, but once you point it out, it's like a pattern recognition. You know what I mean? So you can just kind of see this going up and down here. So the goal right now is this going to hold? If not, no worries. Probably going to touch here. Looks like this is a nice line here. Again, we're waiting for earnings, which is right on that cross section. So there's that. So very quickly, what's Al Stock Trades? Again, our mission is to empower retail investors to win against Wall Street. We've already shown you in regards to the covered calls and cash secured puts what type of money you could essentially be getting. You could just multiply the percentages of what I'm getting for Oscar from my portfolio. If you were to want to do it at $14 to $15 versus the $3 range, and you could see, you can make anywhere between 100, 200,000, anywhere between, 800 to, if it's Palantir's price, the $3 to $4 million per month, right? And you could see the power, and that's what I'm doing right now on the larger portfolio, right? So you could see that like this can be done, and it can be done at the comfort of your own home. You just have to have the data and have to have the community to basically be able to, just talk things through and talk about your thesis, which is again why, again, prices are going to be raising. A lot of folks have signed up. I would say only about 20% have integrated on the stock terminal Discord. So definitely for folks that have signed up, please go ahead and integrate, because you're losing on the most important part, which is the community. So definitely take advantage of that, because the community is very helpful. They're thoughtful, and they're in your shoes. We're all in each other's shoes. Obviously, some more than others, and ultimately, it's just a good way to take the application of this data and see how other people are using it, because that's how you learn, right? So take advantage of this. Also, you are also cutting 2.5 billion outputs of institutionally graded data from the Discord stock terminal. So for folks that are interested, I don't know what you're waiting for. Coupon code SAS, $1,200 off. Take advantage. So from that right now, very quickly, this gentleman here, I think he has like an H index of like 96, which is pretty damn good. He left a very successful academic practice. He has an H index of 95. Previously Duke, PhD here. And, it's unfortunate because, he states that he left successful academic career in STEM after publishing 200 plus papers. He believed, he believed in science and truth, and learned the system valued optics over integrity, conformity over courage. But no, sorry, science and truth. But he learned that the system valued optics over integrity. There's no integrity in academics anymore. And it's all about conformity versus courage. The back in the day when people were in academic institutions, like, for example, Cormanian Brodmann, who classified Brodmann's area, he essentially, rose out and said, I don't believe in this. I believe in this. And he went against the grain, and these types of, almost like a wild west PhD, it was looked up upon. And obviously in the beginning, people said, oh, you're crazy. But ultimately, institutions encourage such behavior. But now it's all about, institutions are just business models. They're endowment funds. They're just dressed up hedge funds. That's pretty much what universities are. And you have an academic, and bureaucracy replace discovery, egos replace expertise, and silence replace accountability. It's time to speak clearly about what universities have become, and it's unfortunate because, looking at basically what I've been going through and looking at academics, I can tell you right now, the papers that are being published, are garbage. There's a bunch of garbage papers out there. And I'm just looking at, all the papers that I've contributed. And I'm like, well, how much of this is actually good? And how much of this is just plain garbage? You know what I mean? Garbage in, garbage out. It's just garbage data going into the academic arena. And then obviously, more papers that get set in, more journals make. And then ultimately those papers are, with primary data are not probably the best. And then you got the collection of all these meta-analysis and systematic reviews that are just plain garbage. And it's just unfortunate, right? There's so much garbage. And this is, no wonder why society is looking down upon our profession, because I think we lost accountability. The point of me mentioning this is a lot of these folks, unfortunately, even in universities, cannot think for themselves. I mean, Jay Crazy, you can go ahead and, you can tell me, but if you were to split your class between people that think for themselves versus people that just, follow the rules, I would say a lot of people that are in MBA, they really, it's hard. They're trying to break out. They're trying to break out, but a lot of them, don't know how to think for themselves. And unfortunately, academics and institutions, don't really teach you that anymore. It's better. They want you to be a pencil pusher and not question kind of your reality, which is unfortunate because that's the whole purpose of science. Again, the purpose of life is to ask questions. A life not examined is not a life worth living. But anywho, moving forward now, and this is how we're able to basically create this platform, create our stock terminal, create our first principle, mindset to allow us to find asymmetrical opportunities to where we're able to basically find patterns like Palantir in the $6 region, and then be able to exploit that using data, and then ultimately generating a large portfolio amongst all the other stocks we found, and even before YouTube, where I'm able to invest $50 million in the next 15 years in Arizona. And all that's having to do to being able to learn how to think for myself. And it's unfortunate because you see a lot of retail investors don't know how to do that, but it's not their fault. It's a system. But if they continue on this path without actually going ahead and breaking out of it, then it ends up being their fault. And they translate this virus onto their children, and their children can't think for themselves, which is why you have the top 50% of people in the bottom class. I'm not saying poverty is a choice. I'm just saying that people are scared to break out, right? Especially folks that are in middle class. People get comfortable. People that are lower class, it's a little bit more difficult. Now, and speaking from firsthand experience, right? So based off of this right now, earnings, big thing, Tuesday before open, United Healthcare's reporting. Wednesday before open, Humana's reporting. Thursday before open, CVS and Cigna's reporting. The big ones are going to be United and Humana. You can go ahead and read what I put here. So if a lot of retail investors love, United. Again, SoFi is one of the Chamath stocks, right? So this will be interesting. It could be cross-pollinating. I don't know why, but it is what it is. But a lot of retail investors have been pretty sympathetic to United Healthcare, and they've been basically buying the dip. And this is potentially an opportunity for institutions to basically give them the dip, and honestly, give it to them. Robinhood call out. We called out around $9. We called this out around $90. Now it's $500 plus. Now it's $100 plus. So the big thing is, if United gives a bad earnings, it's going to send the whole healthcare sector down, and including Clover. So regardless of what Clover's doing, how well it's doing, how industry medical costs, it's gonna go down, and you're gonna have to understand that. So a lot of people are gonna be like, why is it going down? This stock is a piece of crap. Oh my God, I hate the stock. But they don't understand that the whole healthcare sector is down because they don't know how to think for themselves. All they see is just one stock price. They don't know how to look at other stock prices, look at the industry, and go from a 30,000, 40,000 feet perspective and actually pretend like you're in a hot air balloon and look down and actually understand the systems and look at different cul-de-sacs and understand basically how they work, right? But unfortunately, people don't do that. But hey, if you can, that's your edge, right? That's going to basically be able to split you between the haves and have-nots. Hopefully you'll be part of the haves, especially with this new fourth industrial revolution. Now, with the United Healthcare Group, if they do post good earnings, and that's it. We bottomed out in healthcare. I don't know, right? It's going to be pretty rough. But for Humana, I'm more optimistic because their Q1 reports have been doing really well. Because they pulled out a lot of the unprofitable markets, and I'll be listening to them closely, specifically to listen to anything with maybe subscription as a service and SaaS for Counterpart. But again, I'll be very worried because the CEO is pretty tight shut about that. Now, Donald Trump signed a big deal with the European Union that opens up about 450 million people to the United States. That's going to unlock trillions of dollars in capital inflows. Specifically, the EU agreed to invest more than $600 billion in the United States in terms of manufacturing. And the deal includes a 15% tariff baseline. And there's going to be strategic investments, especially U.S. energy exports to Europe. So, all of your energy transfers of the world, all those things are probably going to do really well now. If not, they have already done. Likewise, this agreement echoes Japan's $550 billion investment. And really, this is really good, guys, in my opinion, because imagine all this capital unlocked and now European Union is open for business. Canada, I think there's some discrepancies there. I haven't followed up with Canada yet, but shout out to all the Canadian folks that are part of Lifetime Access. We love you, right? Regardless of what the administration we have, again, it is what it is. But in terms of in regards to this is going to unlock a lot of capital, and I can only imagine the GDP associated with this. I think GDP is going to trade like a meme stock now, and then if this happens, then with the rate cuts, and especially in 2026, you're setting yourself up for a fusion frenzy in the stock market, especially with small caps. So this is definitely very bullish news. The market, I was surprised it's not really up that much on the news, but that just basically tells me a lot of this was baked in, right? So there's that. Now, overnight, Clover's up 0.16. Again, not too much. This one's up 3.54 open door, so that'll be something to watch. Oscar, again, it's up 6.64, even though it's been down lately. We've calculated the intrinsic value. We'll do a deeper dive on a part 2, but really for this video, we're going to go ahead and do an intrinsic value calculation on Clover Health. Now this is the meat of the video here. This is where things get interesting, okay? So that was a big 13-minute, very quick, kind of basically up to speed, put you up to speed in the market. Now, all right, so to get access to okay, we could go ahead and read this, but first I want to just show you something. So if you go ahead and type in Clover Health right now on our software and you go ahead and activate it here, you look at net income. Q1 last year, they lost $19 million, but then the same quarter from a year out, they lost negative $1.27 million. So if you do enhanced AI analysis, you can see the improvement and net income was 93.935%. That's a 93% improvement in profitability from quarter 1 2024 to quarter 1 2025. So now that you have that data in your mind, let's go ahead and read this. So Clover Health's upgrade from 3.5 stars to 4 stars under CMS, which is Centers of Medicare Medicaid, is a major turning point that many let's see here. I lost my place. I'm so sorry. It's a major turning point that many are underestimating. So this improvement qualifies the company for an additional 5% increase in government, and as what Market Cap talked about. And I like Market Cap's posts here regarding in 10 years, he believes, Vivek, stated this, he believes that it is possible for Clover to have made the biggest positive impact in healthcare while simultaneously accruing the largest market value in healthcare in excess of any healthcare company that exists today. That's a pretty bullish statement, and it's really going to show you the level of just confidence he has, and then we can back it up by numbers, which I'm going to go ahead and do. And unfortunately, there's going to be some people that don't understand it. For folks that don't understand it and want to learn more, we have an educational platform, because ultimately, this is, what are you going to, okay, fine, that you make money on this stock, what's next for you? Don't you need to understand how to do wheel strategy? Because what happens, they're going to find another stock they think they're going to lose money, and they're going to hold 3, 4, 5 years, and I'm not going to be talking about whatever they're going to be invested in, right? And then they're going to end up losing. So again, at the end of the point, you've seen our data, you've seen what you've seen our due diligence, and we've seen the persistence, right? And it's an obsession, and you want to go ahead and align yourself with someone who's obsessed, because those folks tend to, they're winners. Okay, so given this, CMS already confirmed another 5%, so they're pretty much going to get on average 10% expansion. So assuming if Clover doesn't grow in revenue next year, then are you telling me they went from negative 19 million last year to negative $1 million this year for Q1, right? You're telling me that an extra 10% then is not going to push them to profitability? You'd be crazy to think that they're going to still be unprofitable, right? That's why all these analyst estimates are cuckoo for Cocoa Puffs, right? You're telling me that an extra star rating from 3.5 stars to 4 stars payment plus an extra 5% raise from CMS, which is equivalent to anywhere between 9 to 10% increase. Actually, I think it's going to be a lot more. I think it's going to be 14%, but 10% increase. You're telling me that's not going to push them to profitability? They're already at negative 1 million, right? I can give them $1 million right now and they'll be profitable. You understand me? So you see how close they are to profitable? But let's go deeper because it gets more funnier than this, right? Because what about the cohorts that are effectively managed? Isn't next year those cohorts are going to get a 700 basis point reduction? And how about the other cohorts that are on their third year? Aren't they going to get an 800 basis point reduction? You could see the flywheel business model. Every year, new cohorts get either a 700 basis point reduction or an 800 basis point reduction for a total of 1,500 basis point reduction. And then the new growth, imagine they grow again 37%, right? They grow again 37%, then those cohorts are going to be basically in queue for next year for 700 basis point reduction. And then the year after that, another 800 basis point reduction. So you could see that every time a new cohort basically comes in, the first year is the stabilization cohort. The second year is the 700 basis point reduction cohort. The third year is going to be the 800 basis point reduction cohort for a total of 1,500 basis points. So you can ultimately see how this flywheel model is initiating. So based off of this projection, what do you think the profitability could be for Clover Health? Well, I'm gonna tell you, right? So based off of this right now, we're gonna make what? 1850, right? We're gonna make 1.8 billion this year, right? If we take an extra 10%, assuming this year we're gonna be break even, right? I think we're gonna be profitable this year, right? Touching or at least break even. But let's just assume we're not gonna make any money next year. We're going to get an additional 185 million. Okay. Now let's go ahead and let's just kind of just assume that we're going to lose 5 million in every quarter. So let's assume we lost 5 million last quarter. Did we lose 5 million last quarter? No, we lost negative 1.27 million. We lost 1 million. I'm saying we lost 5 million. I want to be conservative. So that's fine. Let's be conservative because I want to make money, right? And I'm sure you do too, right? So 5 times 4 is 20 million. So let's assume that they're going to lose 20 million this year. I don't think that's going to happen. Let's assume. That means next year you take 185 minus 20 million, then I expect them to be $165 million in profitability next year. Unless their cohorts start basically increase utilization, the same bullshit that's affecting all the other healthcare stocks, or the new itemizations that they grow into, the new cohorts start spending a lot of money. But again, like we described, a flywheel business model. So based off of this, I'm expecting at least $150 million of net income next year, right? And that's not including the potential net income that we might even get from the new cohorted members. And also, let's not forget the potential revenue that we might even get from SaaS, from the counterpart, which is kind of dangling in the void of space, which we really don't have any access to. People can tell us, oh, what do you think? We've done we've done speculations, but it's tough to touch that. Okay, so now we have this number. This number looks a little interesting. Let me explain. So you go ahead and go to our software here, right? And you go in and you activate institutional, analyst estimates, okay? And we're going to go ahead and go to net income, okay? We're going to go ahead and go to net income. And I just want us to zoom in on this. Just actually, we don't need to zoom in like that. We can zoom in like this. Let's just focus on this graph. Really quickly, let's go ahead. Critical thinking, definitely important. Yeah, sold PLTR at 15, hood at 17 because I know nothing. How do you learn? So we have, Don, I think we spoke before regarding our platform, how it calculates intrinsic value. We have a lot of videos. I'm going to be focused right now on calculating intrinsic value, but you have you have a pathway here to learn and to look at the fundamentals, for example, for hood and whatnot, and you'll be able to figure out kind of the intrinsic value. So you have the platform. So whenever you're ready to make the switch and to join the platform, then you got it, right? How do you find triple dragon stocks like PLTR? What else? Yeah, so we have a channel dedicated for people that are searching for stocks that are triple dragons. And we're going to end up basically creating a search criteria that shows from negative to positive free cash flow. We're going to end up doing that. It's in the works. It takes some time, but our platform is a starting point, right? So that's, and again, we spoke before. So, hopefully, you seeing the due diligence here will help, at least give you some insight. So look at the analyst estimates for CLOV. This is bullshit. Look at 2027. This is completely off balance here. 2027, they did this on purpose to negate it. This is an outlier. They did this because they did a max and min trying to hide 2027. 2026, they expect them to be unprofitable, which is complete garbage. And then 2025, they expect them to lose 26 million. Again, which is again, I don't agree, but we'll see. But what's interesting is look at 2029. 2029, they expect them to make 160 million. Guys, I think in 2028, they're expecting them to make 140 million. Listen, guys, I don't think they're going to make 160 million in 2029. I think they're going to make 160 million in 2026. I think next year they're going to make that 160 million. So what does that tell you? I think the analysts are 3 to 4 years behind. And are they doing this on purpose? Of course they are. They know what's going on, right? But they're going to alter this and they're going to change it, and it's going to make it look like it's never happened, because that's what analysts do. But we have these videos to showcase for folks that are watching from the future. You can basically see the data here, okay? Now, based off of this, and now that I said that, I think they're going to be $165 million in 2026. Now let's go ahead and take a look at this. So Oscar CEO talked about price to earnings and said that his stock in 2027 is going to be anywhere between $45 to $55. Obviously, this was earlier. Now a lot of shit happened. They're going to try to fix things. So to do that, now let's go ahead and look at Oscar. So Oscar used to be negative PE. Then all of a sudden they turned profitable. So let's go ahead and showcase this data so we can support what we are basically saying. So if you look at Oscar, guys, and if you look at net income, Oscar didn't start becoming profitable until Q1, Q2, and then Q3 and Q4. But ultimately, if you look at profitability on a net income basis, you could see Oscar was only 25 mil. Now, if you look at the quarterly basis, you could start to see that it became really profitable, 275 million. So you could see the PE ratio was around 40, 41, then 60, and then 75 for pure speculation. Okay. Now let me tell you something. Oscar, unfortunately, now they're about to be negative $250 million negative in operating income when they used to be positive 250. That's a shift between 500 to the downside. Okay. So now let's go ahead and find, what we're gonna do is we're gonna calculate the price to earnings valuation, which is exactly what we teach in the stock terminal in our lifetime access. And we're going to also have calculations for that. We already have one for price to sales. And it's a lot easier to do. I personally like free cash flow. That's how you make your money. But this is good for profitability. And unfortunately, I haven't been showing a lot of this, and Wall Street's wondering how the hell do I know this? But it's very simple. It's not that hard. Given that we were just talking about free cash flow a lot. So now that we went ahead and did this, now let me go ahead and open up a Google Doc. Hold on. So here's a Google Doc. So we're going to take the max, which is around, what is that? We'll say the max is 76. I know it's like 77. We'll just say max. All right. So here's Oscar. And here's the max. We're going to take the median or the mean. We're going to take the min. So here this we said is 76x. This is price to earnings. Okay. The minimum, which is simple. We just look at the minimum. is 41. For folks that don't know, healthcare right now is between 12 to 15, 16. I think Humana's 16. It used to be like 20, 25, around that. So now let's go ahead and take the mean. And again, the way to write this is for every $1 invested, you're expecting, sorry, man, I haven't done this in a while. I think I need to basically review price to earnings. Let me. Well, if the price to earnings is 76, does that mean for every $76 invested, you're expecting $1 in return? Yes. So that's what, okay. I just wanted to make sure. So for every $76 you invest, you're expecting $1 in return. And for every $41 you invest, you're expecting $1 return. Problem is when it comes to growth stocks, it's very difficult. This becomes you kind of toss us out of the box, but it's a good way to do some form of baseline evaluation. So you go ahead and do 76 plus 41, and you go ahead and divide that by 2. You essentially get 58.58. Okay. So now that we know that this is 58.58x, X. So now we could go ahead and look at the mean, and you could see now let's like, for example, let's take a look at Oscar. Okay. So let's go ahead and type in Oscar here. Oscar's is 254 shares. Their net income right here. Let's highlight their net income. Well, here we said 25, but remember quarterly, their net income. You see how sexy this is, guys? Very sexy. Net income is very beautiful graphs. You can switch the line, and that's very nice. I can't believe, I worked so hard for this, guys. You have no idea. This is obviously going to be, you can't really use this here, right? So this is all, don't look at this, right? So you got to input the correct assumptions. So here's the net income, and you could see 275 million, and then you can add it trailing 12 months, but let's say 275.27. So that was the net income. So if you basically take 275 divided by whatever the shares are, 254, you get 1.083. That's the earnings per share. So you take this and you multiply it with these, and you see where this can go, right? So, but for the fiscal year, here they got net income 25 for Oscar, 25.43. So if you do 25.43, you get 0.1. Now I'm curious, if you take 0.1 times 58.5, yeah, so it shows you that the price to earnings was a lot higher. I think what Wall Street was doing, again, you got to look a little deeper into this. Let's see, Q1, Q2, Q3, and Q4. So what they're doing, I see what they're doing. So they're expecting this and this. So what they're doing is they thought they're going to grow 56 million in Q2 2024. So they said, okay, 275 plus 27 plus another 56 million. Okay, then they subtracted Q3 and Q4. So that's about 200 million. So you got 131 million. 131 million divided by 524, which is the outstanding shares. That's about 0.25 multiplied by whatever this number is, 58. You see, that's exactly what they did. Okay, so let me explain to you. Okay, so what Oscar did and what investor did is they got $275 million in Q1 2025. Q2 and Q3, they're expecting them to be positive here, but negative. So if we were to replicate and just add these numbers, assuming that Q2 and Q3 and Q4 of 2025 would be the same, obviously it's not. They revised downwards. But if we were to add all of these together, so let's add all these together. We have all these jumbled numbers here. We'll add them together. If you add all these together, you get 123. Then if you divide by the number of outstanding shares, which is 254, you get around 48 cents per share for earnings for this year. You go in and then you go back to our Google Doc here and you multiply it by 58, you get what? $28. Okay. Then, that's obviously, not what it's not what it traded at. Then you could go ahead and multiply it by, I'm just giving you kind of what Wall Street was looking at. Then you go ahead and multiply it by 41 and you get $19. Okay, that seems more appropriate. Then you multiply it by $35, you get $16, right? So you could see, yeah. So yeah, we did it correctly. It ended up subtracting accordingly. If you go ahead and take the, I mean, we could go ahead and just do it. We could just do it manually here. I'm going to do it on I'm going to do it on my phone here. Let me see, just in case. 275 plus 27. You're telling me this is wrong? Plus, minus, or let's add the 56.21, subtract 54.6, subtract 153.55. You get 123. So yeah, I was right. So you get 123. You take that divided by the outstanding shares, you get essentially the price to earnings. You multiply by the price to earnings, you get your stock price. So this is going to be like your extreme bullish. This is going to be kind of your upper bull. And I would say this is going to be your base. And I would say 35X is going to be your bear. Okay. So lower end min. So what am I doing right now? So for folks that are lost, again, I'm sorry. This is why you need an educational platform, right? So you can't just, give them data and expect people to understand this, right? Because I didn't understand this. Most people don't even know what outstanding shares is. Most people don't even know what a stock is. Most people don't even know where to even go to buy a stock. You know what I'm saying? So, okay, net income. What I did is, as I extrapolated, I said, okay, Q1, they made 275. Let's assume Q2, Q3, and Q4 are the same, okay? If we do that, we end up getting 123 million. Obviously, that's a fallacy because they just revised earnings downwards. So Q2, 3, 4, and they're going to be different, okay? But when we do that, we go and get 123. You go ahead and take 123 divided by shares outstanding. Why are we doing that? That's how you calculate earnings per share. How do you know that? Well, let me show you. Earnings per share calculation. You go in and to do earnings per share, you do essentially net income, which is what we're trying to basically do, divided by the outstanding shares. That's pretty much it. There's no dividend, so we can remove that from the equation. We go in and do earnings per share. Then we take earnings per share, we multiply it by the price to earnings that we estimated from the market of what it basically gave. We did the max and min and the medium, and we get these ranges here. And then I showed and proved it to you how that worked. So now let's go back to Clover. So we calculated and we said, we said 185 million. We said subtract, let's say minus 20 million, let's say 165 million. Okay. Now, if we have 165 million of net income, so 2026 for Clover, net income, let's say is 100 and again, if it's lower, that's fine. We're just going to take time, but I think it's going to be profitable and I think it's going to be over 100 million. Okay. But let's say 165 million for Clover. So for Clover, it's a little bit different, because earnings per share is different. To do Clover, you have to go here, type in Clover. This is the most accurate earnings per share because it steals it from the most recent earnings report. 508. So that's how many, right? So you have 508 outstanding shares. So you take this and you divide it and you equal it and you get this. You get 0.324. That's what we're expecting earnings per share going to be next year. Now, again, obviously, it could be more. We're not we're calculating kind of a no growth rate, and we're assuming that new members don't offset, the net income. It could be 100. It could be 100, which is why we're going to do extreme bullish, bull, base, and then a bear. And then you could go ahead and take a 20% margin of safety on top of that if you really want to. So now that we went ahead and did that, let's go ahead and multiply it for the extreme case. All we're doing here is we're taking 76 times 0.324. You do that, we have an extreme bullish case of $24. We do 58.5. We have $18 here. Okay, we have $18.95. I'm just gonna round up or down if I have to. Then we go ahead and multiply by 41. We get equals $13.28. And then if the bear case, we'll multiply by 35 with the earnings per share of a calculation of 0.324. We take 35 multiplied by 0.324. Let me get that math here. That is $11.34. So now you can see anywhere between $11 to $24. Now, if you really want to, we can say this is the, I hate my life case. So we could take this and say, you know what? We're just going to cut the profitability by half. 165 million divided by 2. Let's assume that they're going to, because expenses are going to be crazy, they're only going to make 82 million in profitability. Okay. You take 82 million divided by 508.92, you get 16 cents earnings per share, which is kind of funny because a lot of people are thinking they're going to make 11 cents this year. So, I mean, that's kind of funny. 16 cents. You go ahead and multiply it by, the bear case like that. So if you take the I hate my life case and screw the bull case in this case, you could just use the 35 bear plus the I hate my life, which is the halving of the net income, and you would still get 0.5. You would still get essentially $5.67, which is still higher than the stock price today. Okay, so this is how you do it from the intrinsic value perspective for Clover, right? But using the data for Oscar, because Oscar gave us a hint. Oscar gave us a hint because they were profitable for a short amount of time. I think they're about to seep back into unprofitability. We'll see, right? But Oscar gave us a hint. Oscar gave us data. You see this data? Alignment Healthcare can't give us this. Alignment Healthcare is still negative. Humana, United, they can't give us this because they're all burning cash right now and they're dealing with garbage. They're just dealing with shit right now. Not like, they're just, medical cost up, and you can't use that because it's a lot lower. I mean, you can, right? But it's a lot lower, right? But Oscar gave us a hint. Oscar showed us what the PE ratio is, right? And we can take that and apply that. Now hold on. We just took so what happens, let's say, if Clover ends up having a higher profitability in the future? What do you think is going to end up happening, right? What do you think ultimately is going to happen, right? Every year they become more profitable, more members become more profitable. It adds to net income. These numbers are going to keep going up and up and up and up. And then for all my lifetime access members, we're going to go ahead and do this calculation and continuum and grow it at a respective growth rate. And then we can go ahead and have your own intrinsic value from that prospectus. And then you'll be able to basically calculate the value from that. So you'll have many calculations. We have the intrinsic value calculation, we have the price to sales calculation, and you have the price to earnings calculation. And all that's going to be included in lifetime access, which is why we're going to be increasing prices, because we keep updating it. And as the stock price goes up, most people are going to realize what we're doing actually works, and they're going to want in. The problem is we don't want the wrong people in. We don't want the to the moon people. We want people that can think for themselves. So if you're that, join us. Okay. If you're a beginner, join us. If you're an expert, join us. The platform works. Okay. So use coupon code SAS. And I'm surprised. No one has, no one had, how you put SAS in the coupon code? Everyone did it. I'm happy. That's good. Now that I said that, I'm sure there's going to be a couple people that are not going to do it. I'm like, come on. So make sure you put SAS in the coupon code, because that really saves me the headache, guys. Really make my life easy, please. Okay. Okay. So there's that. Okay. So let me think. So $5 to $24. Okay. So this, again, I'm expecting this for 2026 and 7. So I think 2028 is going to be higher than my call out. Okay. Again, let's assume these targets are for 2028 and 2029, right? Let's assume these targets are for, assume they're going to be long-term. I think they're going to be short-term, but assume they're going to be long-term. Okay. because sometimes things take time. If there's like a war, if there's an atomic bomb, if there's a recession, then it doesn't matter what this is. The market will be down, right? It doesn't, the valuations don't matter, just like what you see now. Okay. But I'm expecting them, give it some time to basically permeate in the market, right? But I think by 2027. But again, let's call it 2028 plus. Now that we went ahead and did this, now let's go ahead and do the free cash flow calculation. So to do that, let me go ahead and do investor relations. We'll go here and we'll open up the cash flow statement. You could see, if you don't believe net income can improve by this much, look, they went from negative 339 to negative 213 to negative 43. You're telling me they don't, and what do you think 25 is going to be, 2025? Either it's going to be profitable or it might be zero. You're telling me they're not going to improve? Come on, right? So what we're going to do right now is we're going to take 47 million is discontinued operations. So that's going to be gone. So we're going to take, hopefully there isn't any more discontinued operations because that'll be freaking annoying, but we're going to take 82 million. We're just take 80. We're going to drop 2 million. We're going to give 2 million and donate it to charity. We're not going to put it in our calculation. We're going to take unpaid claims. We're going to increase it by 20 so we can subtract it so it's more conservative. And we're going to add back in 43. And then we're going to add back in what we're calculating here in terms of profitability at 165 million. So to do that, we take 80 million subtracted by 20, add 43 million because we're going to go ahead and add to break even. And then next year we should be adding 165 million, if not more, right? Because we calculate here. By doing that, we get a free cash flow now of 268 million on average. Now, again, plus or minus, that's why we have the bull base and bear and recession case. So now we have 268 million of free cash flow. So now that we go ahead and do that, we go ahead and put this in and we go ahead and put the free cash flow here, 268. Now for the growth rate. The growth rate, we'll do a conservative case, and then we'll go ahead and do the other one. So 9.33 is what, let's say 9% is what we grew last year in 2024. This year, we're going to grow 37%. Let's say in 2026, we're going to grow another 37%. You divide that by 3, you get a 27.67% growth rate. So 27.67% growth rate. You go ahead and do that. You go ahead and do this view here, the classics view. You get a recession case of $10.62. A bear case of $21.53, a base case of $29.39, a best case of $42.85. So you can see ultimately why I like free cash flow, because it gives it to you without any bullshit. But again, remember, this is a growth rate of 27%. What happens if they start growing 40, 45%? Again, I don't know. Remember, Chamath Palihapitiya stated that in 2023, once they reach $1.7 billion, they're going to be profitable. I think Clover Health's, again, it's called, I forgot what... Dr. Michael Burry recommended a textbook. Yes, The Big Short. He recommended a textbook for me. I gave it to Lifetime Access. It's like a big, huge textbooks for finances. And we break it down in Lifetime Access. But there's something called a steady state for a business. And the steady state essentially basically means at what level of revenue does the business need to become profitable? And I think it was 1.7 billion of what Chamath was saying. I think that's what he was saying, that they're going to be profitable. So I think potentially we might be profitable this year. Again, very tough to say. But based off of this, let's assume the high range, which is, let's assume they're going to grow 37% from here on out, which again, it's better than growing 80%, which I think is bullshit. If you look at alignment, all this other people, they're going 42%. They've been doing that for a while. So assume, let's see the high range. This is a pretty good conservative range, I would say. Let's say the high range now. This is without SaaS. You do 37% growth rate. This is what you could expect to see. $18 for the recession case, $39 for the bear case, $54 for the base case, and $81 for the best case. Again, guys, this is without SaaS. This is just literally using the data that we have, right? And assuming, and what I'm doing is I'm projecting, this is different. I'm projecting free cash flow now. I'm projecting free cash flow for the next 2 years. And I'm trying to see in the next 5 to 10 years what this could be. And we might even see these prices sooner than later. Okay. So this is why I'm very bullish on this. And again, for folks that are like, Al, I have trust issues. This looks too good to be true. I can't see this. Okay, that's fine. Let's go ahead and do intrinsic value calculations on 2 companies. Okay. So let's go ahead and open up 2 different price targets. Again, you can have access to this on your phone, on your computer. Again, you can take it anywhere in the world with you. So now let's go ahead and let's calculate the intrinsic value of, let's say, Palantir. Okay. So Palantir right now, and again, it's very dangerous to do this because you're assuming that they're going to keep growing like this. Palantir is growing 39%, 39.934%. So watch this. So we're going to put Palantir here. Okay. They're going to grow 39.34%. Again, you want to go ahead and do more of a longer range. It's a little bit safer, but we're going to do that there. PLTR's free cash flow right now. Let me go ahead and hit enter. This is the quarterly, so mind you, right? Let's go ahead and just use 2024's data, which we know is going to be a lot higher in 2025. 114. Let's take this number. You go ahead and do this here. You go ahead and hit enter, and you go ahead and hit Classics View, and you can see Palantir's going recession case 20, best case 91. Wow. You see how the best case is $91? But now here's the problem. Is Palantir trading at $91? Let's go ahead and see. The answer is no, right? Palantir's trading at 58. Why? Let me go ahead and show you. Intrinsic value calculation graph. Because intrinsic value, like I said, stocks trade either above or below intrinsic value. There was a time where they're trading below. It was a margin of safety. It was a buy. Here's intrinsic value. Now the intrinsic value is here, but now it's trading at $154. This is greed. This is greedy. This is greed, guys. This is what you're seeing is greed. So what people are doing is they're basically pushing out free cash flow. Let's do free cash flow at 1,800. Now let's do free cash flow at 1,900. So they're pushing it. Okay, let's do free cash flow at 2,200. That's 2.2 billion, 176. So right now, let's say 2,000, right? So right now, what investors are doing is they're buying Palantir at a future ended up free cash flow extending 1 to 2 standard deviations above from the mean intrinsic value of the average free cash flow of what we had at around anywhere between $800 to $1 billion. So basically what you're seeing here is that Palantirians are the newer ones are basically wanting to buy 1 to 2, 3 years ahead of what the fundamentals are basically saying. So what does this basically give you in terms of ingredients? There could be a possibility, again, this is greed. There could be a possibility that Palantir may touch back down to $80, $90, right? Because what did I tell you? We take this 1,100 again. You could take the quarterly, which is free cash flow here. Last quarter, they got 126 million. This year is 304. Again, a lot of good stuff here. So the free cash flow could be a lot higher this year, right? Again, if they increase this 400 freaking free cash, that's freaking insane. 415 free cash flow, they can go up to 700, 800. That's what they're banking on. And if that happens, then it's going to be sayonara. Because if you do the enhanced AI analysis right now, look at its free cash flow. Its free cash flow is going 139%. So that means if we were to do that, and if we just were to say, that's why it's important to have this data. If we were, and again, it's very difficult to grow 139% all the way through. But if we do this, this is why it's important to do enhanced AI analysis, because it gets you far ahead. Now watch this. If you take this number and grow at 139%, what would be the number? So that's what it's growing from Q1. So it's going to be 2.7. Holy moly. So this is exactly kind of what Palantirians are expecting. But again, to offset that, to think Q2 and Q3 and Q4 are going to do the same, that's gambling. But again, this is kind of what they're doing right now. So I wouldn't be surprised if Palantir touches $218. Okay. But again, regardless, from 146 to 218, I think we're going to go down, and we might go down maybe 20% above the 2024 fiscal year free cash flow best case. So I would say maybe we might go down maybe to 125, 130, who knows, right? But you could see how accurate this is in terms of finding value, right? We put it for Clover, we saw 18 to 81, right? So you could see that, right? Now let's go ahead and do another one, right? Let's do I don't know. Let me think. Let's do now it's the 20th best company in the world, right? So let's do, let me think. What company should we do? A known company, not some bullshit company. Let's just show you this works. Let me think. I don't know. Apple's a good one because Apple trades above its intrinsic value. So Apple, because there's a lot of greed, right? So here's Apple. We do Apple, and you can see 46, 80, 102, 140. And you look at the free cash flow for Apple, and it's 108. So you could put this there, and we can use the same growth rate. You could see 100. So if there was a recession right now, Apple would fall down to 150, if not less. So if you look at it right now, in the last time there was a recession, where did Apple fall down to? It fell down here, the 129. That was a bear case. And then here's 2020. You could see Apple fell down to 120. So that was a recession. So you can see stocks trade again above their intrinsic value when they're well known. Okay, now let's do another one. Let's do good. Let's do Hood. Yeah, let's do Hood. Yeah, of course. Why not? Okay, you do Hood. And we've done Hood. For folks that don't know, look up my videos for Hood when it was trading at $9. We did the intrinsic value there. Okay, here's free cash flow. So here's free cash flow. It's finally getting positive. It was negative last year. So that Q1 was negative. So 640. And right now it's 927. So you take 640 divided by 927. Just assuming the rate of percentage of what it's expecting. So yeah, that's a bit crazy. I don't believe that number. But let's go ahead and just use the free cash flow here. So free cash flow. So now we can do Hood. So 191. Again, very tough. It's high gross margin business, impressive business. So we can go ahead. We could steal this number. Again, I'm doing this very quickly. I would spend more time on this, so that we put this number. There it is. You see this? Again, I'm doing this very quickly. All I did was I put Hood. So I'm going to hit enter. I put Hood. It sends the data. Then I go in. I steal this number because this is for Robinhood, right? This is the free cash flow 1160. I go ahead here, put this there. The growth rate is around 32% of what it's calculating, right? Which technically is a little bit conservative, given if you go to Hood right now, it's technically growing in the most recent quarter 50%, but it's fine. 32% you could see. Recession case $35, bear case 73, base case 101, and best case 149. It's currently trading at 104, right near its base case. So you can see how all we're doing is we're using these numbers here. We're using these numbers here to calculate the price of Robinhood. Okay. So now let's assume, let's go back to 2022. So in 2022, they were negative. So what you can do is you could take this number, 1,358, and you can multiply it by 5%. Okay. And obviously it's going to give you a lower free cash flow. That'll give you 67. 0.9. So if you do that's 67.9. By doing that, you get anywhere between $2 and $8.76. Now, if you go to Hood, it was trading at that a long time ago, right around here. See that $8.85? Let me zoom in. See that? Right? Because the market in was evaluating it as that. But if you're smart, you would have seen that the gross margins are actually high. So you could assume that it probably would be anywhere between maybe 20% of the revenue can go to free cash flow. So if you're smart, you could say, you know what, I'm going to go ahead and I'm going to take whatever the revenue is here, multiply by 20%, that's 271. You could put this there, and then it was trading at $8 at the time. You could see that, it's actually worth $8 to $35. But as it improved, the free cash flow ended up being higher than 271. It went all the way up to $1 billion. So you could see the power of this, right? You could do Microsoft, right? Here's Microsoft, right? again, Microsoft here. Here's free cash flow. Here's 74 billion. You could do MSFT here. Again, MSFT is a stock that's I'm going to remove this. We don't need another one. Microsoft is another stock that will trade above intrinsic value because people see it more like a bond because it's like safe. But again, that's kind of dangerous still, but it is what it is. So you could go ahead here. You look at the free cash flow. It's about 74 billion. We can go ahead, even by using the most bullish things, it's still undervalued. It's still overvalued. What's the growth rate? Microsoft's 13.27. It's around 14. That's fine. We go ahead and hit enter. The intrinsic value of Microsoft is anywhere between recession case $94, bear case $171, base case $224, best case $312. So what are they doing? Right? What are they doing? They're assuming it's trading at $500, right? They're assuming that, again, kind of like what Palantir is doing, right? They're pushing it out, the free cash flow, because of maybe OpenAI or whatever, higher. So, they're let's see, I don't know, 100,000 free cash flow, not even 120,000 free cash flow. Yeah, around. So what they're doing is they're pretty much increasing free cash flow by, I don't know, 30, 40%, right? Again, not like how I like to invest. Let's say, for example, there's a recession or something, and then all of a sudden it drops down to $171. Well, I'm going to buy. Because that's undervalued. But you see how you're not flying blind here? You see how now you understand, how I was able to become a multimillionaire, right? You see how you see how quickly we're doing this. We're doing this calculation. So when we do the calculation for this is for Clover, right? I haven't changed it. And I'm expecting future free cash flow to be 268. And I showed you, if you guys don't know, you just tuned in, just watch the video from the beginning because you're losing out. How to crawl before you can walk and run. You can ultimately basically see kind of where this is at. And I showed you multiple instances. All they need to do now is get their triple dragon, just like how Microsoft got their triple dragon probably. Actually, Microsoft was never unprofitable. They were doing pretty good. They never had it. But another good example of triple dragon is looking at here, for Humana, right? Since 1990, right? So ultimately, this is the power of our platform. And again, it's a GPS, right? You don't have to rely on analysts anymore. You can create your own price target, right? And this price target, you can go ahead and look at. So like what I like to do is look at the price target of intrinsic values of healthcare stocks in the industry, like I did with Oscar. Like, for example, for Oscar, you can do Oscars and, you can do all these other ones, and you can basically find what the stock should be trading at. I'm honestly curious. What should Alignment Healthcare trade at? It's unprofitable now, but let's see. All right, $9, $18, $25, $38. You can see right now it's trading near the recession and bear case because of what's happening in the healthcare market. Okay. You go ahead and type in Clover. Clover, again, it's we have 58 million growing at 19.48% based off of the numbers today. You got 146, 276. So it's trading between the bear and base case, right? And you have the best case of 523. But if we go ahead and add what we did in the beginning of the video, it translates to this because they're going to be profitable next year. How do I know that? Again, it goes back to basically what I was saying here, right? Next year, they're going to be paid 4 stars. That's 5%. Then CMS said they're going to be paid another 5%. That's 10%. And then the second year cohorts are 700 basis point reduction. Third year cohorts are 800 basis point reduction. So you could see ultimately how you'll have next year, you'll have a 700 basis point reduction cohort and also an 800 basis point reduction cohort. And it becomes a flywheel model, right? So you see how powerful this is. So again, if this is making sense to you, or if you want to learn more, the platform is available. You can start calculating these within literally seconds, and anyone can basically do this. If you don't have like some type of genetic chromosomal malformation, like a problem, then you'll be able to do this. If you do, then unfortunately, you're probably not watching this video, right? But if you're a parent that has a kid like this, and perhaps maybe you should learn how to do this, given how expensive healthcare is. Again, the point is the platform takes you from zero to hero, and anyone can do it, right? Coupon code is SAS, and just to be very clear, you type in SAAS in the coupon code box, you'll get $1,200 off. This is one-time payment, lifetime access. You'll never pay a payment for the rest of your life. and you get to pass it down to your children on a licensed household agreement. Again, this is all about generational wealth. I don't understand what you're waiting for. This is the most cheapest thing you can find online. This is the only thing that you can buy that will actually make you money, right? And you have lifetime access members that are beating their chest saying this. We literally have lifetime access members doing the same thing. Okay, random question. How much would the premium be on a 40 contract, Oscar? Nearest price to, oh, well, it depends how many shares you have and whatnot. We could do that on the next video. How about that? We'll do that on the next video. Okay. That'll be a good video to talk about, especially as the market opens up. You'll get updated options chain. But yeah, guys, that's it, right? Once you understand the math, you realize what investments are. You realize that you're no longer investing in a stock. You're actually investing in a company, and you have to look at the company's financial metrics. But instead of going ahead and trying to click on all these buttons, you type in the stock, it gives you all of this data. And then there's enhanced AI analysis, and then there's a generate insights button to basically explain this to you in large language model format, which we have access to given our proprietary stack, right? This is the new era of learning from a fundamental analysis, financial literacy, educational platform standpoint, and you have access to it, right? You can use this anywhere in the world. We have access to over 60 stock markets, and we are in over 44 countries. This is the real deal. And I can't wait to see you there, making your millions, breaking out of the poverty chain, breaking out of the matrix, and getting to the life that you deserve. God bless you all, and I'll see you on the next one.